Okay, right. Hi everyone. So what we're going to do today, really tonight, really this morning, sorry, it's late, is I'm going to go through this AFB Limited question, where again we have to prepare a cash flow, profit and loss statement, income statement, and statement of financial position, or the balance sheet. So I hope you can see in the bottom right hand corner the AFB Limited. We've got 11 entries here. And what I've just done is I've prepared the format. So that's the one thing to do. And again, just to repeat this theme, is that the whole idea behind what I'm doing is filling in every single thing on every cash flow, every statement that we have, one by one, rather than having to go back and go through all the different points on the cash flow, all the different points on the profit and loss, and then all the different points in the statement of financial position. This is going to be much quicker, hopefully. So let's get right in. Now, just before I just go over again what I've done here. So I've got the cash flow, very easy to remember. Cash in, cash out, net cash flow, which is the cash in minus the cash out. Add that to the opening balance, and that will give you the closing balance. And then in the profit and loss statement, or the income statement, we've got revenue, less cost of sales gives the gross profit, less all the expenses, and these are operating expenses, gives you the EBIT, the earnings before interest and tax, and then less interest gives you the profit before tax, or the PBT, less tax, and that will give you the PAT, the profit after tax, or the profit for the year. Less dividends will give you the reinvested profit, or the there's another word for that as well. And the important thing here, the reinvested profit, that will go all the way into reinvested profits under equity. So equity usually has two columns. It will have, two row entries. It will have the share capital in equity and also any reinvested profits. So that's what comes from the income statement, or the profit and loss statement, is the reinvested profits that go into the equity section on the statement of financial position. That's why it's important. The cash flow is important also for the statement of financial position, because that the closing balance will give a description of any cash in the current assets. Okay, so cash will go into current assets, closing balance will give that entry. So let's get started. So number one, the first financial year saw the company issue 100. Now this is important, the first financial year. So immediately we know that the opening balance is going to be 0 because it's the first financial year. So the first financial year saw the company issue 100 ordinary shares with a nominal value of £2 at £2 for cash. Okay, so issue 100 ordinary shares with a nominal value of £2 at £2 for cash. So that's £200 income, not an income. Sorry, I should really go over here. £200 share issue. Okay, so we've got cash in £200, and that's going to be equity, so share capital it's going to be 200. Okay, issue 100 ordinary shares with a nominal value of £2 at £2 for cash. Yeah, okay. So that's £200 worth of shares at £2 for cash, meaning that that the actual cash value is the same at 200. Okay. Number two. Now, is there anything else? Share capital 200. No, there's nothing else in share capital. Now, now one thing just maybe to note over here, that we always say that the assets have to always equal the equity plus total liabilities. So we've got non-current liabilities here and the current liabilities over here. So everything basically over here in this column has to equal everything in this column over here. So if we've increased the equity by £200, how come the assets haven't increased? Well, if we go to the cash flow, what we have got is £200 in the cash flow. Assuming nothing else happens, our closing balance at the moment would be £200. in cash. That would be a current asset in cash, £200. So at the moment, the assets would actually equal the increased equity over here. It's just that we haven't transferred the closing balance into the cash as a current asset just yet. Okay, so that's point one. Now, number two, obtain a £500 bank loan at 10% annual interest. Obtain a £500 bank loan. So £500 coming in, cash. It's a bank loan, which is great. Doesn't affect the income statement. But now we've got a non-current liability. Loans are always a non-current liability, not current liabilities, because we're expecting to hold that loan for longer than a period of a year. So we can put over here non-current liabilities, £500 bank loan, £500, okay, at 10% annual interest. So it's always good to write a little note of any additional things that may crop up. So we've got 10% annual interest. That's going to be £50 per year interest. Okay, and immediately I can put that in the interest column over here as £50. And we're going to be deducting the £50 interest from the EBIT. So we put it in the bracket over here. Okay. So is there anything else? Obtain a £500 bank loan. So we've got the £500 in cash coming in. At 10% annual. Okay, we put the bank loan there as a non-current liability. Remember, that will be offset by the current assets, okay? Because again, assets equals equity plus total liabilities. So why isn't that on the right-hand side? Well, it is kind of because we put the £500 in cash. So far the closing balance will actually increase by £500. And therefore the statement that we're going to put over here in cash under current assets will also increase by £500 as well. So that's okay. And we've also put the interest in over here that's payable. That's £50 over there. We also need to put a little note as well that the £50 of interest needs to be paid. If it's not paid, if there's no other point in 1 to 11 that says that this interest is paid, then that £50 has to go into a current liability, which we would call interest payable. So what we'll do, we'll put a little star somewhere just to say £50 of interest must be paid. I know you can't see that because it's behind the question over there, but just put a little asterisk or something just to make sure that we've dealt with this either by pulling it into a current liability if it hasn't been paid, or if it has been paid, we're just going to put that into an expense. Sorry, we're not going to put it into an expense. We're going to put into cash out. Okay. So I think that is okay. Obtain a £500 bank loan at 10% annual interest. So these are some of the extra things that you need to think about when you're doing this. So that's important. That 10% annual interest, that £50 interest, definitely goes on the income statement. But if no other mention of it comes up in the rest of the question, we're going to have to put a current liability in there. Okay. Because it hasn't been paid yet. Another approach would actually be to write it in now, and then we could always cross it off. I'm just thinking if that's a good idea to do. I think it probably... I'm not going to do that, but you could do. And in fact, in an exam, I probably would, just because that way it's definitely in and you're not going to forget it. But anyway, we'll come back to that. And we can put a little number 2 in there as well because it's point 2. Now, point 3. Pay annual rent for the year of £4. Pay annual rent. So rent definitely goes in expenses because it's an operating cost. Pay annual rent for the year of £4. and that's actually been paid. So cash out, we can put that in there. Rent, £4. And remember, we're not going to adjust any assets or liabilities because it's actually been paid. If we had the rent expense of £4 and it wasn't paid, that would be current liability. If we had rent of £4 and let's say we paid £10 because we wanted to pay more just for, against future things, then we would have £6 in the current asset in prepaid rent. So again, you only put things into current liabilities or current assets if there's some kind of time delay between what we should have paid or what we shouldn't have paid, kind of thing. All right. If there's no time delay, if we have an expense and we pay for it, we don't have to worry about the statement of financial position. Now, that is number 3. So I'm just going to read that again because I want to be very thorough. Pay annual rent for the year of £4. Yep, cash out £4. Rent expense £4. Nothing doing in the statement of financial position. Okay, that's fine. So number 4, buy equipment for £50 cash to be used for 5 years, depreciated using straight line method. So equipment, £50 cash goes out, nice and easy. Equipment is never put on the profit and loss statement, but depreciation is. Depreciation of equipment. And that's going to be a non-current asset, equipment, because we're expecting to use that for more than a year. So we can put equipment over here. Buy equipment for £50 cash to be used for 5 years, depreciated using straight line method. So at the end of the 5 years, it's worth nothing. So 50 divided by 5 is 10. So it's going to be worth £10 less. So that's going to be worth £40, and that's going to be equipment net book value. And there's going to have a depreciation of £10. Okay, because depreciation does go in operating expenses. Is there anything else we can extract from that? Equipment for £50 cash used for 5 years, depreciating straight line method. And I think that's fine. Next, point 5, buy inventory on credit on account for £50. By end of year, still owed £12 of that £50. So we've got inventory. We'll put inventory on here as a current asset. £50. We've got an asset. Buy inventory on credit for £50. By end of year, still owed £12. So we've got trade payable here. And current liability of £12, meaning we still owe £12, meaning that we must have actually paid £38. Yeah, because if we paid £38, that implies that we've still got 12 more to pay. So we paid £38 in cash for inventory. Okay, so let's just check that. Inventory on credit for £50. So our current assets increased to £50. We have a liability of £12 at the end of the year, but we must have spent £38 actually paying for it. Okay, I think that's point 5 done. Now let's look at point 6. Sold on account, credit terms for £90, 75% of inventory bought. By end of year, account customers still owe £20 of that £90. So point 6 is something that I think if something's going to go wrong, it will go wrong here, because there's actually quite a lot of things to do at point 6. So let's break it up and let's do like the easiest part first. So sold on account, credit terms for £90. That's your revenue. So your sales here is going to be £90. Okay, doesn't make a difference if it's a cash sale, credit sale, Okay, because remember, the income statement is always accruals. It's always what should have happened. Okay, what should happen, not what does happen. Nothing to do with cash. So sold on account credit terms £90. 75% of inventory bought. Okay, so let's do 75% times, now the inventory bought, that was in point 5, buy inventory on credit account for £50. So £50, we actually sold 75% of that, meaning that the stock that we sold actually cost us £37.50. So we can put cost of sales at £37.50. Okay, and the reason for that, again, the actual cost of sales is only the sale items that are only the cost of those items that we actually sold. So since we only sold 75% of stock that costs £50, 50 times 0.75 is £37.5, £37.50. Okay, so sold on account credit terms for £90, 75% of inventory bought. So that gives us the cost of sales, 75% of inventory bought. So that also means, by the way, that if we sold 75%, that means that we're left with 25% of our original stock, okay, which is £12.50. So we can cross out this 50 and we can put £12.50 there, okay, because that's how much current assets that we actually have now. All right, so sold on account credit terms for £90, good, in revenue, no cash. 75% of inventory bought, they're good, because that's will be our cost of sales. By end of year account customers, and we've also made that adjustment in terms of our inventory stock and our current assets. We've reduced it now to £12.50. And by end of year, account customers still owed £20 of that £90. So we've got accounts or sales accounts receivable. We can put that over here as that's an asset. So we can put receivables. They still owed us how much? They owe us £20 of that £90. Which means they must have actually paid us £70 in cash from our sales, okay? So a lot went on at point 6. Let's just check that again. So sold on account credit terms for £90, revenue £90, 75% of inventory bought. So that we sold 75% of inventory bought. Point 5 says that all of the inventory that we bought came to £50. 75% of that is £37.50. That's how we get to cost of sales. And that will reduce our inventory from £50 to £12.50. Okay? By end of year, account customers still owed £20 of that £90, so we've got £20 receivable, meaning that they must have paid us 90 minus 20, i.e. £70 of sales in cash. Is that looking good? Have we missed anything? I don't think we've missed anything over here. Inventory £12.50, receivables 20. I think that's fine. Now let's go on to point 7. Paid various expenses totaling £6, all paid in cash. So expenses, we can put that here. Operating expenses as various. Operating expenses £6. And that was paid in cash. Cash out £6. Okay. Point 8, paid bank loan interest of £50. and calculated and paid tax bill of £30. So do you remember that we put like a little star by that? Remember that £50 interest over here? So we were already told in point 2, obtain a £500 bank loan at 10% annual interest. So we know the interest should be £50. Now we're told that that was actually paid, which means that we would if we wrote that in current liabilities, we'd cross it off. It's not a current liability anymore. We can just put that as cash out at £50, and that's the interest payment. Interest payment, £50. Paid bank loan interest of £50. Good. That's the interest. And calculated and paid tax bill of £30. So tax bill, £30. And if we don't pay it, that would go into current liabilities because we still owe the tax bill. But we have paid it. Calculated and paid tax bill of £30. We can put £30 cash out over here as tax. Now the question is that would we actually write the tax that we paid in a current asset? Because really what we're doing, we're prepaying the tax. But I don't think that's what they're after over here. Because if you ever prepay for something, that always goes under a current asset. But I don't think that's the case here. No, it's not the case here. I'll tell you why it's not the case. Because normally, when you calculate the tax bill, you'd put £30 over here in the tax, yeah? And immediately you would normally put tax payable in the current liability. As soon as you pay that tax as cash out, the current liability disappears. You don't then create another kind of negative current liability, which is a current asset. Okay, so yeah, so that's why I don't think it would be a current asset. It would be normally current liability because you don't pay it in the year that you calculate it. Once you've paid it, you just remove the current liability, and that will go into that will increase the value of the closing balance, which will increase the current assets of cash over here. So it will balance out, I think. Is that right? Again, let's think about this. Normally you have a £30 tax bill. Yeah, I think that's right. Okay, I'll labour that point. So the next point is, did we pay various? Yeah, paid the tax bill of £30. Okay, number 9. Let's just read that, or just to annoy you. Paid bank loan interest of £50. Yep. £50. Yep. On time. And calculated and paid tax bill of £30. £30. And remove the current liability if there was one there for a tax being payable. Yeah. Okay. Number 9. Salaries totaled £100, but only £90 was paid by the end of the financial year. So salaries would be in expenses of £100. Salaries £100. £90 was actually paid. £90 was actually paid, meaning that we still owe £10 salaries payable as a current liability. Okay. Salaries totaled £100. Yeah, in operating expenses, but only £90 was paid out, giving it £10 current liability. Okay, and then finally repaid £100 of the bank loan. So if we repay £100 of the bank loan goes from 500 to 400, and you pay out 100 in the cash flow, yeah? Bank loan repayment, £100 goes out, non-current liabilities goes down. Is there anything else there on that point? I don't think so. Okay. No dividends were issued. So that should be enough in all three columns to actually work out everything that we need. And that was really beautiful because it meant that we did all three things in one go: cash flow, income statement, and balance sheet. So the first thing to do now is actually just to calculate all the calculations, and I like to do the cash flow statement first. I think it's the simplest. So we've got 200 plus 500 plus 70. That gives us £770 cash in. So we'll put £770 cash in, and cash out. So it's 4 plus 50 plus 38 plus 6 plus 50 plus 30 plus 90 plus 100. That gives us 368. So 770 minus that answer gives us 402 for our net cash flow. Add that to the opening balance of 0, gives us a closing balance of £402. Okay? And that 402 closing balance will then go to our current assets of cash, 402. Good. Now we can do the income statement. I always like to glance over again at the statement of financial position just to make sure that we've included any additional expenses over here, such as depreciation. So we've got the net book value of equipment of £40. We have included the depreciation over there. Inventory, £12.50. Inventory has gone down because we've sold a lot of it, which is fine. Trade receivables, that's what clients owe us. Is that going to affect expenses? No. Cash is different as well. So yeah, I'm quite happy to go ahead and do this now. So if we do the revenue, 90 minus £37.50, 52.5. That's our gross profit. £52.5. All our expenses. 4 plus 10 plus 6 plus 100 gives us £120 of expenses. So we have 52.5 minus 120 gives us minus 67.5 for our EBIT. Minus 67.5 for our EBIT. Minus our interest, £50, gives us our profit before tax, minus 117.5. Minus £30 for tax gives us minus £147.50 for our profit after tax, or profit for the year. No dividends were issued, meaning our reinvested profits are going to be £147.50. So we take that and we put that into reinvested profits, will be minus £147.50. Okay, so now we can start to add up the statement of financial position. So equity, we've got £200 minus £147.50 gives us a total equity now of £52.50 for our total equity. Non-current liabilities at £400 and our current liabilities at 22. Non-current liabilities 400. So our total liabilities are £422. Equity is 52.50. Therefore we can say equity plus liabilities equals 422 plus 52.5 gives us 474.5. Equity plus liabilities. Hopefully, if we've done this correctly, which will be very funny if we have, the assets should actually equal that as well. So let's have a look. I bet they don't. Right, so non-current assets is £40. Let's just do it all. So 40 plus 12.5 plus 20 plus 402, 400, oh my god, I don't believe it. yeah, it bloody works. 474.5. I honestly haven't done this in yonks, so 474.5. Wow, that's a good feeling. That's a really, really good feeling. So the assets, £474.50, equal the equity plus liabilities, £474.50. So that's how you do it. Yeah, I think the key is just to go through things very slowly and carefully, and to read each point sometimes a couple of times. I think point 6 really is the toughest one over here. But I think if you do it like this, I think it's a very good and very thorough methodology. So I hope it helps, and look forward to seeing you in the next video.